Here are 7 lessons from Bill Ackman's $27 million bet that netted him $2.6 billion. Bill Ackman is a hedge fund manager on Wall Street and the CEO of Pershing Square Capital. He's known for turning $27 million into $2.6 billion in a matter of weeks. Interestingly enough, this all took place during the coronavirus outbreak. Shortly before the lockdown, he was on TV defending his bet that the spread of the virus would bring the economy down. It turns out that he was right, and as a result, he was rewarded handsomely for putting his money where his mouth is. However, big bets like this are not all that uncommon on Wall Street. To the ordinary person, these bets might seem lucky, but if you take a closer look, there is a pattern that can be observed. These bets aren't random actually, they meet certain conditions, and below are 7 of those conditions or properties drawn from Bill Ackman's big bet. Number 1 is a contrarian truth many disagree with. So this is the first step. For you to have a big bet that makes huge money overnight, you need to first come up with a contrarian truth. A contrarian truth is something you believe to be true against conventional wisdom. That is the bedrock of the big bet. This is not something you have to think about, it's just something you have to find yourself defending contrary to what the popular opinions are. Certainly, Bill Ackman's bet has this trait. He believed the virus outbreak was going to cripple the US economy. Everybody else didn't think so or wasn't sure. He believed this, and this formed his contrarian truth. But there must be a time trigger for any contrarian truth. It is often an unavoidable event coming that will prove the contrarian truth to be either right or wrong. Number 2 is a downward prediction. There's a famous saying on Wall Street which goes along the lines of this: the bull climbs up the stairs, but the bear jumps out the window. This means the economy goes up slowly, but drops very rapidly. Whenever a crash happens, it happens fast. The economy can lose 20% of its value in days, but it can take many years, or decades in some cases, to add the same amount of value to the market. So the best event to make instant millions is on a market crash. A bet on the market going up is arithmetic and incremental even if you are right. But if you bet on the market going down and you are right, it would make instant millions. And as we know, Bill Ackman's bet was on the economy going down. Every big bet that has made instant millions is always on the economy going down. This is because the economy goes down fast, but it goes up, as you know, very slowly. Number 3 is a minimum risk environment. Big bets don't have to be big risks. In fact, they don't need to be risks at all. Average people think that every big bet has to be accompanied by big risks, but smart investors know better. And in the letter to his investors, Bill Ackman stated that the risk of loss was minimal due to the timing of purchase, which means there won't be overbearing losses if the bet didn't turn right. However, protecting the downside of a big bet is also important. This is why some people who make big bets often have not gone out of business. So, if you make contrarian big bets often, there will certainly be times when you are wrong. So a big bet does not mean big risk. In fact, the bigger the bet, the lesser the risk. Number 4 is a move you can defend with thought leadership. If you can't defend your position with thought leadership, you probably shouldn't make it. Bill Ackman went on TV to defend his position before he was proven right by the turn of events. Every big bet must be able to be defended by insightful arguments. Otherwise, there is only a thin line separating it from insider trading, which is an offense. And an argument with intelligent people is how you verify your contrarian truth. If it's worth betting on, the truth gets stronger on your mind every time you discuss it. Does this mean there will be no fear of being wrong? Well, the fear will certainly be there, but that is why the minimum risk environment is very important. Number 5 is a planned exit. Bill Ackman certainly didn't hang on to the trade for a long time. He didn't sit there waiting for the perfect bottom. I believe he had a planned exit, and his exit shows this. He had the potential of making more money if he stayed longer on the bet. This is where a lot of people would have gone greedy and kept waiting to make the optimal amount of money. So deciding when you want to get out is as important as the contrarian truth, since timing is very vital to success. Number 6 is what to do with the gains. If what you're going to do with the gains is not already clear before the trade is made, one is more likely to get drawn by greed. Bill Ackman has already spent this gain by purchasing shares in companies such as Lowe's, Hilton, and Berkshire Hathaway. It's a form of mental discipline, really. Know what to do with the gains before they come. If not, they're just going to disappear as fast as they came. So I believe Bill Ackman already had these companies he wanted to invest in, and he knew that's where his gains would be going. However, the choice of where to reinvest the gains is another massive decision. And last but not least, tell no one about the specifics until you're out. Here's another important lesson. People suspected that Bill Ackman was making a bet like this. He was on TV to argue his point of view, but nobody knew the specifics until it was all over and he was out. The fewer specifics the public knows, the better. It's reasonable to only announce your big bet after you're out, and it worked out great. So don't put yourself in a position where other people can frustrate your bet. Considering that it was quite obvious that Bill Ackman was betting on the fact that the virus outbreak will cripple the US economy. But there are several ways to still do that. The particular way he chose was unknown until he was out. Big bets like these are tough calls. The average investor needs a solid financial education to make such calls, and sometimes these bets are wrong, and they can create catastrophic failures if they are not properly risk managed. Bets like this one are not daily, weekly, or yearly decisions. They are made only a few times over a lifetime. However, when the opportunity shows up, it's always fascinating when an investor can take advantage of it. Now, if you want to know more about how to make millions from a market crash, you should see this next video, where legendary investor Peter Lynch shares his thoughts on just that.